Hey friends, Lucian here with the Bullish Bears team making this day trading tips video. I'm going to do my best to put in a bunch of different tips and techniques that you could apply to day trading. Obviously, it's impossible to put everything into one video. Trade Ideas picks up the stocks that are moving. They pick up the volume, and obviously, sometimes there's more technical breakouts, and then sometimes there's technical breakouts with news. Obviously, the better the news catalyst, the better the breakout. It confirms the breakout more when a stock breaks out on a daily chart. On volume, that's typically a better setup than a stock breaking out on just a technical breakout. It just kind of confirms it a little bit better. But what you're looking for is you're a hunter of volatility. You're searching for stocks that have volume, ideally with news catalyst, and that has really a good breakout on the daily chart. Now, a lot of times, a stock might break out and it might you might not be able to, it might not be the greatest daily breakout, meaning it might just come out of nowhere. And stocks will do that a lot of times where it might be below all the EMAs, and then volume comes in and just blows through the EMAs. So you might miss the setup, but that's okay. Like, be patient. The one thing I really want to stress to you in this is don't have FOMO, that fear of missing out, because there will always, 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 always be another trade to make. Usually, at least every day. But at least several times a week. So that's where we're Trade Ideas. It should give you the confidence to know that, you know what, if a stock is exploding, it's going parabolic, and you miss the move, don't chase it, because there's either going to be another one that day or at least another couple more during the week. So you might miss the parabolic move, the crazy one, the $2 or $3 or $4 move that day. But I'm telling you, Trade Ideas will find another one that week for you. But just because you miss a $2 or $3 or $4 move, don't discount the 40, 50 cent moves, the dollar moves that Trade Ideas just picks up all the time. So you're hunting for that volatility. Don't get FOMO. Look for the best chart setups. Ideally, you're looking for stocks to break out on daily charts and have good intraday setups on the 5-minute chart, and then obviously getting an entry on the 1 minute. There are also other day traders that maybe don't use the 1 minute and they just trade 5-minute setups. Again, it's a matter of your preference. If you're a quick scalper, you want to get in and out of the moves as quick as possible, the 1 minute is going to be your better setup. If you want to slow down a little bit, the 5-minute setup will slow things down a little bit. But ideally, finding the best daily breakouts and getting your, having ideally a good setup on the 5-minute chart, and then your entry on a 1. That's a really good, with a news catalyst. So if you have a stock about to break out on a daily with a good news catalyst in a good 5-minute chart setup, and you get the right entry on a 1 minute, that's ideally your best setup. Again, it's just a matter of your preference. There are going to be times that a 1 minute's just going to take off, or a 5-minute chart setup would be better. But ideally, you want, having all of those together gives your best setup. And then the whole thing with being a day trader, you got to find what's your most comfortable niche. What niche is most comfortable to you? Day trading, it's all about, like everything else with trading, support resistance. Whether you're um, doing daily, a swing trader, day trader, long-term trader, everything is about support resistance patterns, right? Candlesticks form patterns, they tell a story. Traders follow that story. And then obviously, when you're doing day trading, you want to find the best entry and scalp. You're looking at support and resistance areas. Whole and $half amounts are critical support and resistance areas, like 50 cents, $1, $1.50, $2. And also quarter amounts are too, 25 cents, 75 cents, but mostly whole and $half amounts. And then obviously watching candlesticks and the patterns that they form, those show support and resistance areas, as well as EMAs, these moving average lines. They all tell a story. Now, a helpful tip that you can really put into your day trading strategies is with these EMAs, these moving average lines. You'll see on my chart setup here, I personally use the 9 and the 20 exponential and then there's the simple moving average of the 50 and the 200. Now, here's again, it's all a matter of your preference. There's the 9 and the 20 EMA, but there's some traders that like to use the 13 instead. If you use the 13 EMA, then you don't need the 9 and the 20, right? If you use the 9 and the 20, you don't really need to use the 13. Because when you look at this overall, like I'll go into a daily chart right here, you're going to see that kind of the whole setup here. I'm on just random stock right now. You'll see the 9 is in the blue, the 20 is in the red, the 50 is in the purple, and the 200 is in the black. When price is above all these moving average lines, it's bullish. When it's below it, it's bearish. When it's in between, a lot of times there's consolidation mode. When moving averages cross over, that's a potential bullish sign. So when a 9 EMA crosses over a 20, that's a potential bullish sign on all chart frames, but you obviously have to look at the support and resistance areas. It's impossible to just go through all of support and resistance in this video. It's one of those things that takes lots of time, lots of studying. You got to study hundreds of charts before it really becomes comfortable to you. There's no easy way to explain it, but we do in our course explain the best we can for you for support and resistance and patterns. Again, it's just repetition is the key, watching hundreds of videos. We wish there was an easier and quicker way, but there really isn't. But the tips I really kind of want to focus in on in this video are really these exponential moving averages, watching these crossovers, watching the 9 and the 20 specifically. And, obviously you're looking at it on a daily, right? So you're looking for a chart set up on a daily for a stock to break out above a resistance level, and then you're looking intraday to see what that stock is going to do. So you can see like right here, this stock right here, CAPR, this has a 9 and a 20 crossing over. So you see it crossing over here. As it's crossing over, you can see the stock breaks out above this resistance level. Now you have to obviously look at these other resistance levels. You can see kind of this, back to this area here. You can see some resistance here, some up in here. Obviously, it's eyeballing. Some people will say, well, do the support or the resistance areas at just the body areas. Some will say add including the wicks. Some say adding the wicks and the body. You got to just be aware of them. I like including the wicks because I think traders pay attention to them. But my point being in this, pay attention to these crossovers. See that 9 crossing over the 20? That's potentially a very bullish sign. It's above the other moving average line. So now you're breaking through a line of resistance that's very important. Now you're going to trail it back and find these other areas of resistance and see what happens. You can see this one, it's broke above this candlestick here, but it broke above and it came back down. So it broke through resistance. Now that area became support. Now it's fallen below it. So now it's got to see if it's going to break above or below it. So my point being now, this is a daily breakout right here. It's starting to break out on the daily, potentially see if it's going to go any higher. That's when you want to go to the intraday time frames and look at the other time frames. So you can see right over here. Let me go back to let me erase these and show you. Go back to the daily chart over here. We're going to put a line right over here, that 255. So this was yesterday's candle, or the previous high or the high of yesterday's candle. We'll put one above over here, right? See, looking at this candle here. So now when we go to the 5-minute chart, you're going to see these resistance lines here. So right above, you can see in the pre-market today, this stock broke above yesterday's high, right? So now it's going up here above yesterday's high. Now it's breaking above that other candle right over here, and as you can see, it's very far away. The further price gets away from these EMA lines, the farther, the more they want to gravitate back. And sometimes they come down really hard on a stock like this. Sometimes they come down gradually, but the stock or a quicker stock goes up more parabolic. Eventually, it's going to give a harder fall. But everything within these intraday time frames, they create patterns. It's all about support and resistance on the daily, and then you have to transition it intraday. So you can see these lines are now on an intraday chart, a 5-minute time frame. So now what's on the daily is now becoming intraday. So you're going to have to watch these levels intraday. And when a stock goes up, you're going to see it's creating newer highs, right? So you're going to see this stock went up here. You can see right here and right here, it created some highs earlier this morning, and then it pulls right back down to this 9 moving average line. So you can see the 9 is still above the 20. This is on a 5-minute chart. That's a very bullish sign, and the separation of these EMAs is very, very bullish. The wider that they are separated, the more bullish it is. Now, remember what I was telling you about that 13 EMA? The 13 EMA is basically the in-between between this 9 and the 20. So when you see a price fall right down right here, this candle kind of dips right down below it. That's probably right near that 13 EMA. So when price is anywhere in between the 9 and the 20, that gives you a gauge of it being around the 13 EMA. That's why you don't really need to have it on your charts. I like the 9 and the 20 on here because you can watch price, see where it bounces or gets near to the 20 or bounces off of it. So it's just something to be very, very aware of. But when you're looking to trade, right, if you're doing the 9, I would say either the 9 or the 13, depending on whatever your strategy is. Again, I like the 9. We like riding and taking our entries off of the 9. Again, it's just all a matter of our preference. If you're doing the 13, stick with the 13 EMA. If you're doing the 9 and the 20, watch for price to go back down as close to the 9 as possible to get your entry, whether you're doing the 5-minute or the 1-minute. Now, on a 5-minute setup, obviously, it's a longer setup than the 1-minute. So, again, I'm going to show you a few charts to look at, but obviously on a 5-minute chart, you don't want to get in on a candle way out here when it's so far away from this 9 EMA. You want to wait for a pullback to potentially get back in on it. This isn't the best chart setup, but I want to show you how a stock can just go up and just smack right back down. So, but a lot of people will like get it and see this thing moving, and then they'll buy it way up here, and then it smacks back down. But what you're looking to do, I'm going to clear some of this drawings off here, is when a stock, it opens up, right? When a stock breaks a high of day, that's a potentially bullish sign. So you can see this is the first 5-minute candle of the day. This isn't a bad setup per se. It's a little bit far away from this 9, but here's the thing. Now you got to think about risk management and what your risk management strategy is going to be. When you get in above a bigger candle, it is more risk. It's, obviously if you can get in on a smaller candle, it's better risk. Bigger candles equal more risk. So you can see this candle right here, 285 down to 265, not too bad. That's a 20-cent risk management. Not saying that you should have just definitely gotten in on this stock, but to show you, on a stock like this, if a stock breaks the highs over here and holds, the base of this candle is now, this is obviously critical support, but it's a matter of, if the stock falls and goes below this 5-minute candle, that's bad, bad, bad. But obviously once it breaks a 5-minute candle like this, you don't want it to fall back below it. That's a very bearish or potentially bearish sign when it closes below it. A lot of times it'll break above, retest, and go. That's okay. That's why a lot of people get in on pullbacks. You can see this one it broke above, came back below, closed, but it's still above this 9 EMA. Now you have these little kind of like these doji or these smaller candles. That might be a little bit better of a risk area because they're smaller candles to get in on. But if you got in on a break of, let's say, this 5-minute high of day break, you're going to want to sell towards the peaks. You're going to see, what is this right here? 285 to 312. That's a big pop within the first 10 minutes. Take your profits. If you were to get in on a high day break, risking the base of this candle as your stop, if this goes up, obviously take your profits, because look at it, it's very far away from the 9 EMA. It's going to want to gravitate back. If you miss your entry, don't chase these big candles. Wait for it to fall back down. You want to be very careful of these wicks and shadows here. This might not be the best one to get on. This, again, I'm going to show you a few examples. You want some cleaner ones. You want ideally some hammers around here, not necessarily a doji long thing like this. But I'm trying to give you an example of, like, this stock still goes up, smacks all the way back down, and it's still staying above this 9. If you get the right entries, you can ride the 9. This is on the 5-minute. I'm going to show you on 1-minute entries as well, but we're going to look at the 5-minute for a few minutes and go over a few. Let's look at a few that are running today for the on the 5-minute charts. So you can see here, separation between the 9 and the 20. Obviously, it's very separated, so that's a very bullish sign. So when it gets above, like farther away like this, you ideally, when a stock takes off, you want to wait for it to kind of pull back towards this 9. And if it holds the 9, you can ride the 9. If you're a 5-minute trader, if you get the right entry, you can ride the 9 until it breaks down. So for instance, now, obviously right here, you know, if you got in on the high day break right here on that break of this high day at 90 cents, it did go back up. It went up here. If you didn't take your profits and you waited for it to come back down, it came down right below the high day break, but it bounced right back up, kind of consolidated a little bit, and then it kind of formed almost somewhat of like a wedge or a kind of a flat top here, broke, and look, it rode the 9. It went up, kept going up, and then your first close, technically your first close below the 9 would have been right here at that $1.24. So if you were to just ride the 9, again, this is a strategy that a lot of people do. If you get your right entry, you can, if you get in an earlier entry back, you know, over in here, you could ride the 9, and then when you get your first candle close below the 9 on the 5-minute, you can take your profits and get out. Obviously, if a stock gets really parabolic, you know, if this thing was up at $2 or $3, you're probably going to want to take your profit before it comes right back down. That's going to be, again, all a matter of your risk management. But riding the 9 is a strategy that you can do if you get the right entry. Again, mapping out support and resistance. When a stock breaks a high of day, you don't want to see it collapse below it. So obviously, if it breaks a high day here, it came back down and retested. That's normal. But if it closed below this, that's a bad sign. You want to potentially get out. But as it's consolidating here, another resistance level is now support. Once it breaks, you want to see it hold. If you get a good entry, again, as long as price stays above that 9 EMA, that's still a bullish sign. So obviously, there's some people like to get in stocks and just kind of ride the 9. Again, if you get the right entry and it gets parabolic and price is way up over here, super far away from the 9, take your profits and then wait for re-entry. Wait for these little pullbacks and consolidation towards the 9, and then get in when it breaks. So there's high day breaks on a flat top. But then there's other ones where like a candle will break up like this, come back down, you know, and you could wait for it to break this hammer potentially. I don't like this setup per se. I'd like to get it more over in this area, these smaller candles. Ideally, these smaller kind of doji or hammer candles that are consolidating, and this flag is a little bit better to get in on. And then when a stock goes and breaks above it, obviously you'd be careful of, you could either get in on a high day break on this flat top, or you could have gotten in over here on this flag, watching, you know, in anticipation of this high day break, and then making sure that it holds. Again, all a matter of your risk tolerance. My point being is getting your entries as close to this 9 EMA as possible on both the 5-minute and on the 1-minute. Again, I'm showing you the 5-minute, some strategies here right now, and we'll look at some 1-minute ones. Again, perfect example on this. How do you trade this? I wouldn't, like, this thing just went up, completely ripped up, completely ripped back down. Now you can see there's a clearly defined top on the day of that 154, and you have the bottom right down here at 105. went up, smacked right back down, and then you start seeing, so playing big, huge candles like this is very, very dangerous. You can't say, I mean, the terrible risk management strategies. But if you start to see this consolidation in these smaller candles, it's going to be much better of risk tolerance for you because they're much smaller and easier to set your stops. So you can see this stock right here kind of formed a base right down over here around this 120 level. And right, look at that, it's kind of closing, and right when you think it was about to close below that 9 EMA, it didn't. And then you can see it kind of broke above a little bit, forming that hammer, and then boom, broke back up. But doesn't mean, again, you should hold this long term. Again, this is a terrible, like, it's a hard setup to look, but you got a quick pop here, where if you got in at this 121 level and you sold at the top here at 140, that's a 20-cent move. That's a great move. So my point being is getting in as close to this 9 EMA as possible gives you the best risk tolerance. Obviously, it closed below the 9, potentially bearish, but in between the 9 and the 20 is the 13. So sometimes you get closes in between at the 13, and that's okay. The closer it is towards the 20, when you can see when it starts breaking down below the 20, that's a bad thing. When you see consolidation and these moving averages are tight together, that means there's consolidation, and at some point it's either going to, the 9 and the 20 are going to cross and potentially go up again, or cross and go down. But again, it's all mapping out the support and resistance, finding the patterns and getting your entries as close to the 9 as possible, and then being aware of support and resistance levels. So when you got in, if you got in over here on a break of this candle, you have to be aware this is going to be very difficult for it to break these long candle wicks above. So if you get a pop, take your profit at the top, and then if you're looking for entry, look for it. Look for potential re-entry later. Again, I don't like the setup. I'm just trying to show you a few different examples. Another one here, these doji candles, very kind of difficult to watch, but you can see there was some consolidation of these EMAs right here. They were all pinching. Then all of a sudden you can see the 9 went up, crossed over the 20. That's a bullish sign. But if you miss it, so if you got your entry here, you can see, I wouldn't trade this one per se because it's kind of hard to trade. But if you risked and got in at the break of this doji here, you got to sell, or look at the top of these big candlesticks. Take your profit up here. They could be very volatile, but you can see they both still held above the 9. When price is staying and holding above the 9, that's a very key level. But if it's a very bullish play, you want to see it kind of going up. The separation, some bull flags, and I'm going to see, let's see if we can find any that might be just running kind of more casually. Oh, here's one here for us, ONP. So ONP, okay, I'm going to go to a 1-minute chart on this one, start showing you some 1-minute examples. So here's an example on a 1-minute chart setup, right? See this? The EMAs are kind of pinching. They're close together here. It was consolidating back over previous day, right? Consolidating, pinching. Then you have kind of this flat top or this wedge or flag pattern. And then as you can see, the volume starting to come in. And then if you were to take, again, if you got into the break of this one right here, where is this right here? Let me move this drawing. At the break of that flat top, you can see how it's, again, like this kind of this flag wedge pattern here. Once it broke above, even if you, obviously you want to get in ideally here, but if you got in even over here, potentially, obviously that's over $1. So this is very important, that whole and half dollar amount. So you want to see when a stock breaks a whole dollar amount, again, even $1, you want to see it hold. So obviously this one right here, if you got in at the break of it, it's kind of the smaller, somewhat of a pullback candle back, and you could like ride this up. So now this broke $1 here, and then look at it. So then it goes, what is this? $1, $1, $2. And look, it just rides the 9, right? See, there's no close below the 9 until right here at $1.89. So on a 1-minute entry, if you got in right on this one, you could have gotten in right here. Let's even say you got in over here. $1.08. Let's say you're a little bit late. $1.08, this thing just rode up. Now, obviously, you're going to be careful. Obviously, you want to take your profits when you're far away from over here. But even if you didn't, if you missed, so obviously you can see you're giving up a lot more, right? Let me see, hold on. You're giving up a lot more profit right here. So if you got in like in these tweezer tops you were selling up towards here, 230 is much higher than 190. But if you were just doing the ride the 9, when it closed below the 9, you still made a lot of profit. You could have taken more profit up here, but you could have said, oh, this is coming back. This might be bull flagging coming down. It still rode the 9, went up, came back down. Now, again, if you were to be safe and you just sold once it closed below the 9, that's probably like your safest. But just remember, this candle also is still between the 9 and the 20, so it could still potentially go, and that's still near maybe like the 13, and then it kind of found some consolidation here, looped around, it found this cup base, and then it broke out again. So this is, again, there's no way to tell you what's the right or wrong way to do it, meaning like the best way to do it is, number one, have proper risk management on every trade, have a predefined stop and predefined sell areas, take your profits along the way. That's the biggest stress, or the biggest thing I can stress to you. One of the biggest day trading tips is take your profits. But if you're one that just wants to kind of just ride a stock and watch it break down the EMAs, when you find the right stocks, the ones that ride up like this, not the crazy ones like I was showing you, a stock that just rides the 9 like this, you can do the same strategy on the 9 and on the 5-minute. Now you can just do, again, it's all a matter of your preference. The 5-minute would be much slower movement. The 1 minute's going to be a little bit quicker. It speeds things up a bit. But if you put this chart down to a 5-minute, let's just see what happened on this one. Let's go back over here. So you can see how in the 5-minute it would have been so much tougher to trade that. So I showed you on the 1 minute how it looked so much easier to get to, but look at this. On the 1 minute, let me clear the drawings, or on the 5-minute, it would have been the easiest way, would have been able to get it really on this break of the high day in the 5-minute. It's hard to trade this. You got to be very, a lot of courage to get in right here. That 151 down here, almost to $1. That's a 50-cent risk. That's probably not the best. And you can see this one up 1, 2, 3, 4 candlesticks, and then it kind of like they become kind of big candlesticks, but you can get trapped in these wicks here, and these whipsaws can really be hairy and make you really nervous. Really, the only kind of chance you may have had to get in on this one on a 5-minute was when you saw this kind of doji 5-minute candle form. But even that 5-minute candle, let's see, 205 down to 188. It's not the greatest risk management, and you only had that one rip back up. So again, you're wanting to get on a 5-minute stock when it goes crazy like this. You want to see it get as close to the 5 as possible. You really only had this one entry. But if you had the 1 minute up, you would have seen these bull flags along the way, and it just gave you these little entries and pullbacks, some pullbacks towards that 9 EMA. And then when it starts getting towards the end of its run, it gets a little bit crazier. Again, it brings in more traders, so you want to be careful. A lot of people will also say, traders will say, well, they only trade the first and second pullbacks, and they don't trade the third. So, again, sometimes it's more of an eyeball. But you can see there's, kind of a pullback here. There's one here, two here. You got to be very careful in areas like this. Even this is a little bit kind of scary with these big red candles. You can get kind of trapped in here. So the earlier you can get in on the move, the better. But watch these pullbacks. When a stock goes up, watch it come back to the 9. Watch it form like a hammer or a doji or something right around that 9. And then, take a break up on a bull flag and then risk. Again, it's going to be a matter of what your risk tolerance is, but a breakdown, if you're on the 1 minute or on the 1 minute strategy and you got a 1 minute entry above the 9, if it breaks and you get a close below the 9, that's a potentially bearish sign. You might want to consider getting out. Again, it's all a matter of what your risk tolerance is. Um, let's see if we can find a couple more here. Just repetition is the key. So that's why I'm just kind of trying to show you guys just a few examples, just to kind of really, give you an example of how it's done. CAPR on a 1 minute, you can see this one kind of opened up with a big green candle, big red candle down. You could kind of say that's almost right below. See how it just see how that went up, smack back down. It hit the 20. You want to be careful. You want to be cautious of that. But now it's tougher to get a reentry because when it's smacked down off that 20, you want to be a little bit more cautious. Now you have a high of day, right? So there's a high of day here now. It's a new high of day. It literally, so you'll see a lot of times a big fake out. I'll go up 1 or 2 pennies and then kind of fall back down. And then you can see this green candle came in and closed above the line. That is good, but it's still these wicks above. You want to be very careful. Now you see this green candle smaller. It's more of a real body. It's going up in here. That's a better sign. So now if you were going to take this strategy, either one, you could have waited for 5 minutes to form and then got in on the high day break, or you could potentially get in, again, whatever your risk tolerance is, on a potential break of high of day. So if you got in on this candle here, it's still closed above the 9 after it had some shakeouts here. You could have gotten in on the break of this candle here, right around that 278, in anticipation of a break of 282. And then you could have obviously kept if you wanted to have a nice tight stop, you could just literally, you could have just used a close below the 9 as your stop, or you could have used this right here, this below this smaller candle, this 272, 273. Again, I like tight risk management. You could have also used the base over here if you wanted to use this to give yourself more room. But I like tighter the better. If a stock's going to go against me, I want to get out, break out or fake out. I'm taking if the stock goes against me, I'm going to get out. And you know what? Even the best traders in the world fail 40% of the time. That's where your risk management's going to say, am I going to wait for a high day break? Or am I going to get in an anticipation of it? It's all a matter of what your preference is. But if you're going to get in and you're risking on the 1 minute, let's say, a close below that, 9 in the 1 minute is a potentially bearish sign. And as you can see, you didn't really have much time if you didn't take your profit. So if you got in on a higher day break of 382 here, you'll see technically the first close was over here at 287, this red candle. So if you didn't take your profits up here, again, you still were going to be fine. You just only made 281 up to 286 or 7. You only made 6 cents compared to 281.82 up to 312. So you would have had much more profit if you took your profit up here. But obviously, as you can see, price is further away from the 9. So obviously, if you get if a stock breaks, gets above here, take your profits, look for reentry to go back up. But you can see this is one, you're just looking at these patterns. You can see this kind of wedge pattern, this flat top pattern going, breaks out, and then a breakdown of this area is a bad sign. And as you can see, it came right back down. But even if you held strong on this one, look at this. It's still, when it came down and collapsed, it retested the high a day over here, and then it consolidated. Let's see what it did moving forward. Look at that. So you can see it held this line. Let me just remove that drawing here. It retested all the way down here, and look, it didn't break. So that's the other thing you can look at, is it didn't break. Even if you if you didn't take your profit here, it came back down and retested. It didn't collapse below this high day over here. It consolidated. It went back up again. It failed again right here, came back down, and then it did really go back up again. Again, I would not suggest you holding through all this baloney. I'd suggest if you get in, you scalp at the top here when it's take your profits when it's far away from the 9. and then look for it to consolidate, find a base, and then look for re-entries. You can see in the 1 minute here when the EMAs kind of start consolidating and pinching, that's a consolidation mode. You want to see separation, and then you want to see obviously a stock go and break high of days again. So this is the high of day here. Then there was a high of day over here. So you can see there was almost a bottom here, almost another bottom facing, almost like a double bottom or one big bottom. And as you can see, kind of they were separated here, formed another top, kind of came down, and then it traded sideways, and then started to separate more again. And then sometimes it just gives you one like final pop, and you know, you just got to be aware of it. But my point being is look for entries as close to the 9 as possible. The farther away a stock is for the 9, the more it wants to gravitate back to it. Same strategy with the 13. If you don't use the 9 and the 20, same thing with the 13. Let's pretend this 9 EMA was the 13. The farther away a price gets from the 13, the more it's going to want to gravitate back to it. But it's all about these moving average lines. Traders really pay attention to it, and it's following the support and resistance and watching where price is. Take your profits, get your entries as close to support as possible. You know, and these moving average lines are really great areas of support to really pay attention to. So again, you can do it on all time frames. Again, same thing on the daily. You know, watching the 9 and the 20 or the 13, whatever you're looking at, finding your entries as close to the 9 or as close to the 13 as possible. And then a breakdown of that 9 or a breakdown of that 13 is a potentially bearish sign. You got to look at support and resistance and the other things that are going on when trading. So I know there's a lot into this here. I just really want to show you several examples to really kind of show it to you that it's just really pay attention to that 9 EMA. That 9 EMA is your friend. If you get the right setup and it's trending above the 9, you can ride it until you get a close below it. If a stock goes parabolic and you miss the move, wait for it to consolidate back down to that 9 EMA. See if you get a doji or a hammer close above that 9, and then, you know, potentially you can get in on a break of that doji or hammer. You know, obviously paying attention to high a day as resistance. And, you know, if a stock, you can ride it towards those resistance areas for a potential high a day break, but then watch level 2 and time on sales. If it turns against you and it fails at those areas, then take your profits and get out.
If you're not a member of our community yet on Facebook, come and join us. We are the Bullish Bears. You will see right up here, we call ourselves the stock market community, just to differentiate ourselves from our fan page over here. So make sure to like and follow our fan page as well as join our Facebook group. You will notice when you join our community, we keep all the spammers, the trolls, and the stock pumpers out. So we run a really good, clean Facebook group. So if you want to join a community of other traders around the world, make sure to come and join us. Also, too, if you have not been over to our website, head over to bullishbears.com. You'll have the links below, and you'll see over on our website, we'll have several different trade rooms over here. We have a day trade room, we have a swing trade room, a futures trade room, other great areas of support. So not only do we have our Facebook community, we also have our trade rooms that are open 24/7. So you can talk to traders from around the world anytime, day or night. And it's a really helpful resource, especially if you're new and just getting started in the stock market. It's nice to have other traders around the world as support. So we have our several different trade rooms, our Facebook group. We also do watch lists and trade alert setups every night. We send out key breakout and breakdown areas on our alert service each night. We are not stock pumpers. We do not call out entries and exits. We help to teach you to become your own trader. So again, we help to guide you, but we're not calling entries and exits because we are not stock pumpers. So make sure you read about our alert service over here if you want to know how our trade alerts work. We do also have thousands of dollars worth of free courses over here to help you get started. So if you're new, give yourself a few months to get comfortable with trading. It takes many traders, a few months, if not a year plus, before they get really comfortable. And that's why we suggest taking our free courses and then practice in a virtual account like Thinkorswim or Interactive Brokers to really get comfortable. Make a few hundred practice trades, practice in our trade rooms, talk to other traders around the world, and just get yourself comfortable with trading. And then when you're really comfortable, then start trading with real money. You'll see right here, we also have our ebook, so make sure to grab that. We have a free candlesticks ebook as well as our wallpaper backgrounds as well. So we offer so much value to our community members. So if you are not a member yet, make sure to just click the subscribe button over here and you can come and join our community. And also don't forget, if you like this video, make sure to like it, comment on it, and share it. We would greatly appreciate it. And we will see you in our community. Enjoy.